Good morning, everybody. I'm Bagadon at Stock Market Caddy, and today is Saturday, December 2nd at about 11:30, and we're reviewing this past week and getting ready for the weeks ahead and the end of the year. By the way, if you are a follower on Twitter, on YouTube, otherwise where we have your email address, these videos and this information is meant to be inspiring you, not annoying you. If you find them annoying, just send us a note back. I'm more than happy to take you off the mailing list. So just know that. Many folks have sent us and said, Don, please copy us anytime you post something. So that's what we do. It is not meant to be annoying. It's inspirational, we hope. This particular tool we call the Nicklaus timing model strategy. It is a strategy, a trading robot that is operating on a chart, a daily chart, not intraday. It is running on the indice, which is the Russell, the NQ, the YM, and the ES. Individually, it has a data stream of each of the four major indices. It also has a second data stream from the VIX, which is the fair gauge, and it even has a third data stream. What is that data stream? The yield on the 10-year Treasury. What is being talked about a lot lately? The VIX, the fair gauge, yields, interest rates. You see, folks, we've been using this tool for years. We understand what moves markets up and down. Now, there's nothing for me to point to on the chart. It is an algorithm, a mathematical algorithm. It's a black box, not deliberately so. It's even a black box to us. It's been back tested and forward tested. Does it get every single trade right? No. But it does a very, very fine job for us. We like to think that it picks up the aberrations of the market or the market vibrations. When volatility comes in, the market has a tendency to want to run. When volatility expands, the market has a tendency to come in, to pull back. The VIX daily component is also a big part of the Nicklaus timing model. It is a separate algo running on the very VIX itself, and it's just one more confirmation. And it runs in the opposite direction. So when the markets are all long, we want to see the VIX short. Or when the markets are all short, we want to see the VIX long. Now, the last signal that we got was on October 30th. There it is. Now we can deduce that the VIX was in fact long. And that night we cautioned all of our members and said that the market was reaching an inflection point. And one of two things was going to happen. The markets were going to reverse course and get short, and the VIX was going to stay long, and we were going to sell down, or more than likely, the markets would stay long and the VIX would reverse course within 72 hours, get short, and the markets were likely to run into December. We said that night on October 30th. On October 31st, it was confirmed. If you were a member and you placed a mini futures contract in each of these markets, you would be up $85,000. If you used micros, you'd be up about $8,500. If you used 10 minis, you'd be up $850,000. This is all scalable. It would have taken considerable capital to carry a mini contract in each of these markets overnight. We have some members that chose to trade just one market. We have other members that chose to use options. You see, if you had gotten long the ES or the S&P on a call option at roughly 4,200, this is at 41.85, but if you had gotten your call option at 4,200 for December in the options market, that call option would have cost you about $6,000, thereabouts, 6,500, maybe as much as 7. Today, that call option would be worth close to 40 grand. I'm Bag Don. This is StockMarketCaddy.com. This information is available to our monthly members every single night. Our annual members have this very tool on their desktop. It is what it is. Can I tell you from here when the market is going to turn down? No. But when it does, we will all see it. The question is, will you?